Dividends. If you're watching this video, then I can already assume that you know what that word means. And while the rest of the world is crashing and burning, you're poising yourself to be in an advantageous position for the upcoming year of 2023. Or you're just looking for another good way to make some good passive income. And I respect that. So in this video, we'll be breaking down the only 3 dividend ETFs that you'll need in 2023 to help you get to where you want to be wealth-wise. So with the intros out of the way, let's go ahead and talk about dividend ETF number 1, and that's the Schwab US Dividend Equity ETF, or SCHD for short. Currently trading at $78.44, the Schwab US Dividend Equity ETF's goal is to track as closely as possible before fees and expenses the total return of the Dow Jones US Dividend 100 Index. SCHD is a straightforward, low-cost fund offering potential tax efficiency. The fund can serve as part of the core or complement a diversified portfolio. It tracks an index focused on quality and sustainability of dividends and invests in stocks selected for fundamental strength relative to their peers based on financial ratios. SCHD is currently trading at $78.44 with an extremely low expense ratio of 0.06%. Meaning for every $10,000 invested into this dividend ETF, you'll pay just $6 in fees for things like general upkeep, marketing, and management. And pulling up their max chart, it has tripled in value since its inception in 2011, 11 years ago, meaning that if you were to have invested $10,000 into this ETF 10 years ago, that $10,000 nest egg would have turned into a $30,000 nest egg today. Taking a look at its performances over the last 11 years, it currently has a negative 0.48% year-to-date daily total return, 3% one-year daily total return, and 15% for its 3-year daily total return. And taking a look at SCHD's annual total return history, SCHD had only 2 years since its inception where it's entered bear territory, and those years were in 2018 and 2015. Other than that, it's had a consistent increase on average of 20% year over year, which makes it one of the best ETFs out there. On top of its high growth every single year, SCHD also has a pretty decent dividend yield of 3.36%. So again, for every $10,000 you invest into SCHD, you'll get roughly $336 in dividends annually, or roughly $28 monthly. Out of the 103 companies that it currently holds, within its top 10 are companies that everyone has heard of, such as Merck & Company, the pharmaceutical company, Home Depot, the home improvement retail corporation, or Pepsi, the beverage company. SCHD encompasses most sectors, but the top 3 sectors that it currently holds are with information technology with 21%, financials with 20.51%, and consumer staples with 14%, and has a total net asset valued at just a little over $44 billion. So just to recap what SCHD is all about, it follows the Dow Jones US Dividend 100 Index. It has $44 billion in total net assets with a dividend yield of 3.36%, and it's currently trading at $78.44 at the time of recording this video, and has tripled in value since its inception in 2011. And when deciding to buy stocks, you'll definitely want a platform that can keep up with you. Introducing moomoo, a one-of-a-kind trading app that is perfect for beginners and veterans within the stock market world. moomoo is an all-in-one trading app that helps any type of investor become a pro in minutes. One feature that I'm personally using right now is the paper trading feature, where you're given $1 to $10 million in fake money to test out new strategies and new concepts. This way, you're learning how the stock market world works without actually losing out on actual money. Right now, there's a promotion going on where just by simply opening an account, you'll earn 1 free stock. Depositing $1 will get you $10 back. Depositing $100 will get you an additional 4 free stocks, and depositing $1,000 will get you an additional 10 free stocks. So in total, for signing up and depositing $1,000 within your new moomoo account today, you'll get a total of 15 free stocks plus $10. And don't worry, moomoo operates under a legitimate publicly traded company and is also registered with FINRA and the SEC, which means they have to have legitimate financials. And also, because they're a member of the SIPC, you're protected for up to $500,000, including $250,000 for claims for cash. One thing that I've been paying attention to more and more is focusing on where people smarter than me are putting their money. Groups like Berkshire Hathaway, BlackRock, and the Vanguard Group. And moomoo makes it really easy for me to understand and keep track of all of that. All in all, I highly recommend moomoo as your next all-in-one trading app, especially if you're someone who's interested in learning about the stock market world or just someone who wants better analytics. I'll put my personal link down in the descriptions down below to help you get started. Thank you again to moomoo for sponsoring this video, and with that, let's get right back into the video. Alright, moving along, let's talk about Dividend ETF number 2, and that's the SPDR, S&P 500 ETF Trust, or SPY for short. This ETF doesn't need any introduction as it's literally the first ETF ever listed in the United States back in January of 1993. It seeks to provide investment results that before expenses correspond generally to the price and yield performance of the S&P 500 index. It's a diversified large-cap US index that holds companies across all 11 GICS sectors. SPY is currently trading at $402.33 per share, with again an extremely low expense ratio of 0.09%, meaning for again a $10,000 investment, you'll only be paying $9 in expenses for things like general upkeep, marketing, and management. And pulling up SPY's max chart, if you were to have invested $10,000 into SPY when it was first launched in January of 1993, your $10,000 nest egg would have grown into a $100,000 nest egg in just under 30 years. Taking a look at its performances over the last 30 years, it currently has a negative 14.32 Y-to-date daily total return, 13.03% one-year daily total return, and 10.44% for its 3-year daily total return. And taking a look at SPY's annual total return history, SPY had only 5 years since its inception where it entered bear territory. And those years were in 2018, 2008, which makes sense, that was dubbed the Great Recession, and 2000 through 2002, which is better known as the dot-com bubble crash. Other than that, it had consistent increases year over year, which makes it not only the oldest ETF out there, but also one of the best. On top of its high growth every single year, SPY has an okay dividend yield of 1.6% annually, which doesn't make it a strong contender for passive income, but accommodating its high growth each year, it's definitely a core ETF that everyone should own. So again, for every $10,000 you invest into SPY, you'll get roughly $160 in dividends annually, or roughly $13 monthly. Out of the 503 companies that it currently holds, within its top 10 are companies that everyone has heard of, such as Apple, the technology titan, Microsoft, the other technology titan, and Johnson & Johnson, the family company. SPY holds all sectors, but with the top 3 sectors it holds currently are information technology with 26%, healthcare with 15%, and also financials with 11%. And has a total net asset valued at just a little over $367 billion. So just to recap here, SPY follows the S&P 500 index, has $367 billion in total net assets, and a dividend yield of 1.6%, and is currently trading at $402.33 at the time of recording this video, and also has 10x in value since its inception in 1993. And finally, the last dividend ETF that we'll be talking about today is none other than the JP Morgan Equity Premium Income ETF, or JEPI for short. This ETF primarily focuses on stocks from the S&P 500 with a curated algorithm to identify value stocks with low risk and good returns. And its overall goal is to deliver monthly distributable income and equity market exposure with less volatility. JEPI is currently trading at $56.52 per share with an extremely low expense ratio of 0.35%. Meaning for a $10,000 investment, you'll be only paying $35 in expenses for things like general upkeep, marketing, and management. And pulling up JEPI's max chart, if you were to have invested $10,000 into JEPI when it first launched in May of 2020, your $10,000 nest egg would have grown into a $12,000 nest egg over the past 2 years. Taking a look at its performances over the last 2 years, it currently has a negative 2.06% year-to-date daily total return, 1.39% one-year daily total return, and 0% for its 3-year daily total return. Well, that's because it hasn't even been around for 3 years yet. And taking a look at JEPI's annual total return history, it doesn't really have one because it's only been inception for 2 years. but it does have data for 2021 where it recorded an impressive 21.61%. On top of its high growth every single year, JEPI has an insane dividend yield of 10.6% annually, which makes it a strong contender for passive income, but accommodating its growth in 2021, it's definitely an ETF that everyone should own. So again, for every $10,000 you invest into JEPI, you'll get roughly $1,060 in dividends annually, or roughly $88 monthly, which is almost 7 times the amount of dividend that you would get for SPY. Out of the 125 companies that it currently holds, within its top 10 are companies that everyone has heard of, such as Exxon, the oil giant, Pepsi and Coca-Cola, the beverage empires, and United Health Group. JEPI encompasses most sectors, but the top 3 sectors that it currently holds are with industrials at 12.8%, healthcare at 12.1%, and consumer staples at 11.6%, and has a total net asset valued at a little over $14 billion. And what I find most interesting about JEPI as opposed to SCHD or SPY, the other 2 dividend ETFs that I talked about today, is the fact that JEPI primarily makes money via out-of-the-money covered calls. Some would say that this is kind of similar to the wheel strategy that has been popularized over the past couple of years, where as long as the market stays neutral or slightly bearish, JEPI will perform the best. So just to recap what JEPI is all about, it primarily focuses on the S&P 500 index and then mixes some covered calls in there and primarily uses that to make monthly distributable income. Has $14 billion in total net assets and a dividend yield of 10.6%. And it currently trades at $56.52 at the time of recording this video. Alright, I just showed you the only dividend ETFs that you'll need to buy in 2023 to put yourself in a winning position. I showed a core dividend ETF, that being SPY, a growth/dividend ETF, that being SCHD, and also a high yield dividend ETF, that being JEPI. If you want more videos like this, make sure to hit that subscribe button and also visit some of the other videos that I make on this platform. I primarily talk about credit cards, but as you can see from this video, I'm branching out to broader financial topics. Thank you again for watching. Until next time, everybody, stay safe out there. Peace.